Okay, Casey, what do we have on tap for the weekend?
We have had an exciting week here at Chipstock Investor. We're going to look at three companies today. The first one is going to be Keysight Technologies, which we have not covered here. It's going to be a new company for us to discuss, but then we're going to compare that with two companies that we have covered before and really, really love: Synopsys, an EDA software designer, and Applied Materials, which you have been beating their drum for many years now.
Yeah, it's a new company for us, but we thought we'd take a look because we've seen it pop up on as a recommendation as of late, and we think that's because Keysight is kind of unified equipment and software business, which, if you've been watching this channel for a while, you know that we like companies that do both hardware and software, versus Synopsys, which is mostly software with a little bit of hardware, and Applied Materials is mostly hardware or equipment, chip manufacturing equipment, with a little bit of software. So is Keysight a better differentiated business versus Applied Materials and Synopsys, which we personally own? Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this.
Before we dive into Keysight Technologies, reading through all of these earnings calls, the one word that I keep seeing over and over and over again is AI. So, what's up with this? Like, are we ever going to stop hearing about AI?
No, at least not as long as the media keeps pumping AI to get clicks. You're going to let me rant here for just a moment before we start talking about Keysight? Okay. This AI hype cycle is getting really silly. At least for the next few years, the investment in AI, specifically generative AI, like ChatGPT, which kind of got this whole thing started, a lot of the investment into it is going to be primarily tied to infrastructure, chips, networking equipment, companies that design the chips and the networking equipment and such. That's where a lot of the investment is going to go. And as with anything that's hardware based and tied to the manufacturing industry, it's going to be cyclical. So there is tremendous value in being patient and waiting and sitting on your hands during periods like this where a company drops a news item featuring AI and the stock shoots up 10%. Uh, just hold tight. Just wait. So that's a mini rant. I'm done. I'm finished. Be patient out there, folks.
Okay, with that being said, let's jump into Keysight Technologies and why they're poised to grow during this AI hype. Let's just run through the most recent quarter earnings here for Q2 2023 for Keysight Technologies. Revenue was right around 1.4 billion, which was a 3% year-over-year increase. They have a gross margin of 67%, operating margin 30%. They have on their balance sheet about 2.5 billion, which is the 6 months ending in April, and current debt of 1.8 billion. Free cash flow this quarter was 370 million, which was a 51% year-over-year growth.
Pretty good quarter. This looks like a pretty decent business. Maybe just a little bit of background. Keysight used to be part of the HP empire years ago. More recently, that was part of Agilent, which was also part of HP, and then Agilent proceeded to spin off Keysight. What's left over here now is basically an integrated test instruments and software company. They do a little bit of semiconductor manufacturing equipment, but most of the systems that they make are like these modular systems that kind of sit on a desktop next to a computer, and you plug in some sort of either a chip or a computing system or a component of a computing system, and you test it. And then it integrates that little test modular test system integrates with the PC and the software that Keysight provides. Oftentimes, that software also integrates with EDA and other testing software, like, for example, from Synopsys, which we're going to cover here in a moment. So on the surface, most of Keysight's customers are systems designers and engineers. So they're not chip companies themselves, but they're companies like maybe an aerospace and defense or automotive company that needs the chips, but they need to test them and make sure they're going to work as intended in whatever it is they're building. So it would appear on the surface this is going to be a high growth business in the coming years as a lot of non-tech companies suddenly are in need of lots of more chips and maybe short on talent when putting those chips to work. That's in a nutshell what Keysight does.
Looking at the financial highlights over the past 3 years, looking at this, there's not a lot of growth, right? I'm looking at it, and even during like 2020, not much changed really. It's a really kind of flat picture. Why is that?
Yeah, so that's a good question. I guess maybe this pertains to my mini rant. Um, it's an infrastructure business. At the end of the day, it's closely tied to manufacturing, although most of what they do is not part of the manufacturing process itself. It is part of the final assembly and test part of the step before maybe a company needs to emulate what a chip will do before they give the final send off to mass manufacture a particular chip. Okay, let's like make sure it works first, and then if it does, okay, make us 1,000 more of them after we've verified that. Uh, so it's infrastructure. It's going to be cyclical, but Kasey, like you pointed out here, not a ton of growth. The financials are solid, but it doesn't appear that the company is capturing the lion's share of the new market growth and profitability being created by things like, for example, electric vehicles or vehicle automation or maybe 5G connectivity proliferating throughout not just, these are smartphones, but also um, industrial robotics as well. So I think that's kind of what we're looking at here with these slides that you pulled. The growth is just not accruing to Keysight primarily.
And what about their EDA business? Is that something that's going to directly compete with the other companies that we follow, Cadence and Synopsys?
Perhaps to an extent, it will, uh, because as you have pointed out in the few videos now that we've done on Cadence and Synopsys, is approaching half revenue for each of these companies is system designers, not just chip designers, but systems designers. So it would appear on the surface that yes, this is an EDA, electronic design automation software competitor in Keysight. I'm not so sure. I think Keysight is more of an EDA play on, again, the final test and sign off. And I think their software is more ancillary to their specific modules. And if you kind of do some digging on what the company does, you'll find that there's a lot of integrations with, rather than competition with Synopsys and Cadence. Also, a company called ANSYS, ticker symbol ANSS, which makes a specific type of basically like physics software that sort of recreates the natural world and tries to emulate what a chip or a system will do under various conditions. So I think this is more of an ancillary play to the EDA oligopoly that exists.
It looks like Keysight has a lot of competition, not only from this sector that you're just talking about, the EDA sector, but in other instrument companies. There's a ton listed, including National Instruments Corporation, which is getting acquired by Emerson. So what are your thoughts on the competition here?
This is a great point, Casey, and maybe just a little insight into our process here. Whenever we have kind of whittled down a specific sub-industry, and now we're starting to look at the specific stocks that participate within an industry we're interested in, one of the first things we do is we'll look at a new company like Keysight. We'll open up their most recent annual report, the 10K, and either go to the section on competition or hit Control F on the document and search competition. Little handy shortcut if you're not aware of that. And look at what the company lists as their primary competitors. Now, almost all companies are going to have a long list of competitors, but what we're looking for here is there something that the company makes that's differentiated from the other competitors? And as far as we can tell, there's not a lot of differentiation here for Keysight. And I think that is showing up in the financials. Not a lot of growth. Not They're profitable. The company is a very, very healthy profit margin generator. So that's good. But it doesn't look like they have that pricing power to really boost growth and profit over time. And you mentioned the one competitor, National Instruments, getting acquired, currently in the works, getting acquired by Emerson Electric, which is a very large business. So there's also some others here, Teradyne and Teledyne as well, some other big companies in the test equipment space, a lot of other companies out of Germany. This is one. It doesn't look like something that's super differentiated, though it does have the hardware and the software component all unified in one. We think that makes for a very sticky and healthy business. We're just not seeing a lot of opportunity here for real, really, really strong revenue and profit growth in the coming years.
If you look at their Q3 guidance here, it's essentially flat for this next quarter, which is kind of interesting. And then the outlook by fiscal year 2026 of operating margin 31 to 32%. It's currently at 30%. So you can see that it's, as you said, a very profitable company, but is it the highest growth company that we could be investing in? That's the question, right?
Yeah, exactly, Casey. And for a company that's as stable and profitable as Keysight, they do have a share repurchase program, but we would like to see a bigger share repurchase program for a company like this. Also, perhaps maybe a little bit of a cash dividend. Ultimately, we don't see a lot of differentiation here that would move us off the sideline versus the next two companies that we're going to talk about.
So moving on from Keysight, let's go ahead and move into our next company, Synopsys, which we'll make sure that we link our previous videos here so you can take a look at our coverage of Synopsys up to this point. But we have the Q2 fiscal year 2023 earnings report to go over and our outlook for that company. So just as a refresher, Synopsys is an electronic design automation company, or EDA company, in California. It focuses on silicon design, verification, intellectual property, and software security and quality. So running through the Q2 fiscal year 2023 numbers, we have revenue of nearly 1.4 billion, which was flat quarter over quarter, but represented a 7.7% growth year over year. Operating margin was 33.3%. Free cash flow was 654 million. And they have a really nice balance sheet, actually. They have 1.7 billion in cash and only 20 million in debt.
Casey, not a ton of surprises in this quarterly update, but that's kind of the beauty of Synopsys, right? It's a semiconductor business, but it's a software business. So you get all the stability and high profit margins that you would expect from a software as a service company, even though there is a small component here that is hardware, as is there is with Cadence as well. But maybe I'll just run through the three primary operating segments that Synopsys reports. So the first, of course, is design automation. That's the EDA part. That's roughly 2/3 of revenue. That was actually up 13% year over year. Highly profitable. This thing spins off operating margins of almost 40%. And this design automation software used in everything from the actual design of chips all the way to full-blown systems design as well. So this is the bread and butter, and it's still growing. Then there's IP, design IP or intellectual property, about 25% of sales. So IP, this is actually where Synopsys, as well as its peer Cadence, dabble in the chip licensing business, which oftentimes I think we all think of ARM holding. So that's 25% of the business. It's also been growing, but a bit of a hiccup this year because they had a record 2022 for IP. So on a year-over-year basis, this is kind of flatlined for the moment. They expect it to return to growth the second half of 2023. Again, highly profitable business. And then the third and final segment, which we've talked about, is actually a software cybersecurity play. Their software integrity segment, about 10%, the remaining 10% of revenue. They actually just hit the $5 million annualized run rate with this part of the business. And this is actually really, really important here because as chip systems, computing systems get more complex because of things like AI and this whole AI hype cycle, customers need to be able to test the integrity not just of the chips, not just of the system that the chips are a part of, but also the software that the system runs, making sure it's all working the way it's supposed to. There's no security holes that can be exploited once the system is deployed. And then also supplying the software supply chain, because you can think of modern software as being something built or manufactured rather than just written like in times past. Lots of companies are taking pre-built modules and pieces of software, patching them together, and making sure all of those different chunks of software are working properly and as needed and verified. And then the supply chain of basically as those different parts move from one part of the cloud to the next, they need secured. That's what Synopsys does. We'll talk more about that next week when we talk about Palo Alto Networks and compare it with Fortinet. But that's Synopsys in a nutshell and why we started dollar cost averaging into the stock late 2022, early 2023. Paid off handsomely so far.
So does Synopsys do anything with digital twins?
You must have seen my note on this. They indeed do. All the EDA companies, again, a little oligopoly here, Synopsys, Cadence, and Mentor, which is now owned by the German industrial giant Siemens. They've actually been doing this digital twin stuff. Maybe you heard about this from NVIDIA within the last couple of years. They've been doing this for a long time in EDA. Basically, you make a virtual version of the chip or the computing system and simulate how it will actually behave in the real world. So this requires a deep, deep understanding of physics and how real world physics works so that the software can kind of emulate that. And then you get insight on how your chip or your system is going to behave virtually before you say, okay, let's actually go and manufacture the thing in the real world. Incredibly valuable for the industry because making chips is so stinking expensive.
That is super cool technology. It's amazing. Like this point you pulled out from the earnings call from the the CEO of Synopsys, Art DeGoose. He said the semiconductor industry tends to invest strongly in chip design so that when the downturn fades away, they have differentiation, because the worst is to miss an upturn, because that's where most of the money is made. And so that's a very simple point, but it's very accurate, isn't it? Like, if once we're obviously coming out of the chip downturn now, and what if you were stuck on the sidelines with an old design? You're not going to make any money that way. So this is where companies like Synopsys and Cadence come in. They're allowing semiconductor companies to make the most advanced chips.
This is such an incredibly important point, Kasey. It's why Synopsys and Cadence will continue to grow consistently, almost quarter in, quarter out, in a low teens percentage basis year over year. It's because they don't follow the ups and downs of the semiconductor industry. They follow the research and development spend of semiconductor companies, and now also computing companies and device companies and such. And that remains stable in good times and bad, more or less. Research and development dollars have to remain stable in good times and bad, otherwise you get left behind. So these are great stocks to just set and forget for the long haul. We think, for us anyways. One other really important thing here, and this just goes back to my beef with this AI hype cycle that we're experiencing. A lot of companies, NVIDIA, if we're naming names, have just exploded higher in the last year. The time to buy was last autumn, when we were really talking about NVIDIA. Yes, it was expensive then too, but that's because earnings were depressed. But that was the time to buy when the stock was down in the dumps. Again, because of this quote that you just mentioned from Synopsys, you want to buy on the cycle lows. You do not want to miss that bottom, because most of the money is made at the beginning of the next upcycle. So that's why we've kind of de-emphasized NVIDIA, even though at this point it still remains our largest position, in spite of the fact that we keep buying other stuff and even took some profit off the table, because there are other stocks now that are still in the midst of the down cycle that are trading for a long-term value. And it all has to do with this quote that you just mentioned from Synopsys CEO Art DeGoose.
So for Synopsys, it's actually gone up about 8.5% just since earnings, which is crazy, but it's right at 409, 410 per share. So is it the right time to buy? I mean, we're looking at the stock chart. It's never gone down, really. Like, it's just continued to climb. So is this a good time to buy, or is this time to wait?
It's not time to buy, but it wasn't 6 months ago either, when we started dollar cost averaging into it. And I think that is the benefit of a company like this, where it's probably just going to trade at a premium for the foreseeable future, say 5 to 10 years, because of this research and development super cycle. Again, it shows up as the AI hype cycle when you're reading news reports, but really behind the scenes, like we keep kind of pounding the table here, it's just tech infrastructure, or maybe just delete tech out of that completely. It's just modern infrastructure. This is a modern infrastructure investment. It's going to command a premium for years. Timing it is a fool's errand. Yes, it's way overpriced at this point based on what we can see for the next 2 to 3 years, but it's impossible to predict when there might be a dip that brings it down to some sort of fair value. So if you really like this company for the next 10 years and beyond, maybe just dollar cost average into it, and maybe give it a while, give it 2 years worth of dollar cost averaging to build up to a full position, if you like the stock and you want to own it for the long haul.
Now for Applied Materials. This one is pretty easy. We'll just run through the numbers here. Q2 2023, revenue 6.6 billion, which is a 6% year-over-year growth, gross margin of 46.7%, operating margin of nearly 29%, They have 5 billion in cash, about 5.6 in debt. What's our take on this company?
Yeah, we'll keep this one simple because apparently Applied Materials has a big announcement for us come Monday about a multi-billion-dollar investment they're making in future development. It sounds like maybe equipment equipment capacity increases. Maybe they're going to increase their ability to churn out more equipment for semiconductor fabs. It sounds like maybe they're going to apply for some CHIPS Act funding. At any rate, that's Monday. This was a very straightforward quarter, not a ton of growth at the moment, but bear in mind that this wafer fab equipment niche of the industry is in decline this year, and Applied Materials is by and large holding steady. They're able to offset weakness in memory chip manufacturing, as well as kind of this cycle where companies like TSMC, for example, kind of migrate over to 3 nanometer manufacturing. So that leaves a little bit of a lull for Applied Materials. They're able to bridge that gap as well as some economic issues with their ICAPS portfolio, basically the more mature chips. So things for electric vehicles, energy grid infrastructure, all of that is in a new super cycle. And because Applied Materials has a very broad and differentiated portfolio of very expensive equipment, they've sort of just pivoted away from the logic and memory chips, the high-end part of the market that's, part of this whole AI hype right now. And they're pivoting to this other super cycle that's getting less attention: EVs, energy grid, industrial automation. So the two things kind of have offset. And so Applied Materials, yes, it's flat, but during a downturn, if you're flat, hey, that's pretty darn good.
So, what about valuation for this company? It's sitting currently, the stock price is right around $130 per share. Is this a decent price for it? What's your take on this, Nick?
Yeah, you could look at this and say it's priced a bit on the high side. 17, 18 times earnings, 27, 28 free cash flow. But remember, we are by and large close to a cyclical bottom for this part of the industry and for the chip industry overall. So the profitability metrics are going to improve as the year goes on. And then into 2024, I think we're going to see an even more dramatic uptick in year-over-year growth, and thus a big rebound in profit margins and overall profitability. So remember, just last segment on Synopsys, I said you quoted Art Goose from the call. It's the cycle bottoms where you want to invest because you make your money in the first part of the next bull market, the next upcycle. We're still waiting for that next upcycle to kick in for Applied Materials. So we think, yes, the valuation looks skewed towards the high end at this point. Applied Materials is kind of edging its way back towards all-time highs set a couple of years ago. But the next upcycle has yet to really, really hit. It's not yet in full swing yet for Applied Materials. So we actually think, looking out over the next 3 years, the stock is very cheap, in our opinion. And so we continue to like this one. This is still one of our favorite stocks for this year. We're willing to be patient. Everyone can go ahead and chase NVIDIA and the other hyped up stocks on this AI nonsense. We're willing to be patient and wait for the next upcycle to come around for companies like Applied Materials. We'll see you. We'll see you, stock traders, when we get there.
So, in covering these three companies, let's do a comparable here between Keysight Technologies and then Synopsys and Applied Materials. How do you think Keysight compares to these two companies?
I guess I'll just reiterate again. Typically, we love businesses that have some sort of unified hardware and software component, which Keysight has. But the problem with this one is it doesn't appear to be differentiated enough, especially when you have other companies in the industry that are highly differentiated and or operate in a complete oligopoly. like Synopsys does in EDA software, along with Cadence, and Applied Materials, also an oligopoly with primarily four other companies. Both of them highly differentiated in what they offer, and thus they will have pricing power. So you get, I think, cyclical revenue, yes, but overall, on average, higher revenue growth and fantastic ability to generate consistent high levels of profitability along the way, which gets returned to us as shareholders. Both companies very aggressive in buying back stock. Applied Materials has a growing dividend payment. So Synopsys mostly software with just a tiny bit of hardware. Applied Materials mostly equipment with a smaller amount of software. Basically 20% of their business services, software-based services. But again, though they may not be fully integrated hardware and software businesses, differentiated, operate in an oligopoly, very shareholder-friendly companies.
Thanks everyone for watching today, our coverage of Keysight Technologies and our favorites, Synopsys and Applied Materials. Make sure you come back next week for more. We have Palo Alto Networks reporting, and we'll do a comparison between Fortinet and Palo Alto Networks next week, as well as some other things coming your way. So hit the subscribe button. Make sure you share our videos and channel with your friends, and we will see you all soon. Take care. Have a great weekend.